Hey everyone, welcome back to Chip Stock Investor. I'm Kasey.
And I'm Nick. And what are we talking about today? I was thinking about that, not my name.
We both know our names and we're Chip Stock Investor. It's been over a year since we started selling off our position in Marvell Technology and reallocating some of that cash to Broadcom.
Yeah, and of course, we discussed why that was, discussed where we went wrong with Marvell, why Broadcom, also another longtime holding, outperformed. Took some heat from it, of course. Understand why that is if we're, seemingly talking bad about your investment. That's probably not what you want to see when you open up a YouTube video. But for the sake of full transparency, let's circle back and see what went wrong, revisit the topic, and see if anything's changed for Marvell at this point.
But before we get into the nitty gritty, let's give a quick shout out to the sponsor of today's video, finchat.io. You'll see a lot of charts from FinChat in all of our videos.
FinChat is a great research platform for analyzing a business, whatever your thesis is. In this case, trying to figure out what went wrong over the last 5 years and also what the company could do to make things right and get back on track delivering actual shareholder growth. So you'll see a lot of charts from our friends over at FinChat throughout this video and all of our videos. We use FinChat on a day-to-day basis when analyzing businesses and the industries they participate in.
If you want 15% off any paid plan, you can get that link in the video description below or right here on the screen. That's 15% off any paid plan, finchat.io/CSI. To start with, though, let's take a look at our semi-industry flow chart and find where Marvell fits into all of this. Marvell is a fabless chip designer, and they have an extensive amount of semiconductor intellectual property, especially for data centers and enterprise computing. In fact, Marvell's been undergoing a massive pivot in recent years. Pair that with near across-the-board decline in all the other end markets like automotive and industrial. Data centers now comprises over 70% of revenue in fiscal 2025 for Marvell, which ended in January 2025.
Up until this point, that of course has been a very painful process for Marvell. We'll talk more about that here just momentarily. Now we're at a point here entering fiscal 2026. We just got the Q1 earnings update on that. Now that's a good position for Marvell to be in because we are getting a re-acceleration of growth in that AI infrastructure and data center infrastructure. And that could be a great thing for that revenue segment for Marvell. That is, as you said, Kasey, now over 70% of the grand total.
But in order to understand all of this, maybe we need to walk it back and do a little bit of history on Marvell because it's not exactly what went wrong in 2024. That's when the share price boomed and then it fell in 2025 in April. But it's really a matter of what went wrong starting about 5 to 7 years ago. In fact, Marvell wasn't such a great business when Matt Murphy took over, the CEO of Marvell. But starting in late 2010s, there were some legal issues that had been cleared up, and Murphy started going on the merger and acquisition hunt.
Yeah, that's right. We have a little table here to organize all of the purchases that began to be made at that time. And in fact, that's when we started covering Marvell and initially took our position with the purchase of a small chip design segment called Cavium, which was an ARM-based processor designer for networking chips. And there have been some other acquisitions between then and now, the biggest purchase of which was the optical networking systems and optical component designer Inphi. That was finished up in 2021. That was a sizable acquisition at about $10 billion. Fast forward today, it's now crystal clear what Marvell was doing along the way is they were building out all of this IP and design work so that they could participate in the same area Broadcom competes. In fact, that's why we started calling Marvell a few years ago, Baby Broadcom.
They've got everything except that huge infrastructure software business, right?
Yeah, that's right. And of course, even on the semiconductor side, far lower sales compared to Broadcom. It's been pointed out to us that maybe Baby Broadcom is not such a nice moniker for Marvell if you're Marvell for management of Marvell. We meant no disrespect for saying that, though. Anyways, so that was the rationale for all of these acquisitions. And the issue with all of those acquisitions, besides just paying a lot of money to get all of that IP and design know-how in-house, is this particular part of the data center market, networking, is a pretty fierce field full of competitors, right?
Yeah, absolutely. We've just have a sampling here on this slide. You can see there's tons of competitors for Marvell. Of course, as Nick mentioned, Broadcom, AMD, NVIDIA, Intel, Microchip. A lot of the companies that we talk about here on Semi Insider are all competitors for Marvell.
And we should add here, just last week over on Semi Insider, we did a live event talking about updates for Astera Labs and Credo, ticker symbol CRDO, discussed those in a live event and some portfolio changes surrounding those two stocks. Check it out. Semi Insiders hear about all of that stuff first. Link in the description below. Check it out. Totally worth it. And we, of course, do a lot of stuff not strictly tied to semiconductors anymore.
That's right.
We're growing.
Check it out. Do it. So in this market, as with any business, players with large-scale and diversified products like Broadcom do really well, and everyone else can end up fighting for the scraps. So to illustrate the competition, we can pick up on Marvell's own description of two key products from the last annual report: Interconnects and custom ASICs, or application-specific integrated circuits.
And we can further break those down. Let's start with interconnects. Interconnects for the networking part of the data center are things like coherent DSPs, CPO or co-packaged optics. That's a pretty hot term, especially after NVIDIA GTC back in March. LPO, linear pluggable optics, active electrical cable, networking on copper, PCIe retimers. We talked about that last year when we did the Astera Labs deep dive. And a lot of acronyms here, a lot of industry jargon that could possibly be just a bunch of mumbo jumbo to you if you don't work in semiconductors. What are these all exactly? What are all these parts and pieces designed to do?
A good way to think about them is like building blocks of freeway interchanges. So connecting different parts of roads and handling the flow of traffic. But instead of cars, this traffic is digital data for things like training new AI or operating AI once it's been deployed in a software program, or also known as inference.
Wow, you broke that down. That's all inference is? Just operating AI?
That's it.
That seems too simple.
It probably is too simple, but that's ultimately what it is.
Operating the software. Okay.
So all these chips are used by network server companies like Arista Networks, who is a top Broadcom customer, to increase the number of lanes and increase the speed limit of the roads within the data center.
And again, that could be copper, it could be optical. Data center companies, especially the hyperscalers, think Microsoft Azure, Amazon AWS, Google Cloud, Meta, and so on, love having lots of options available. And thus, that's why you end up with such a crowded field within the networking chip industries.
Okay, let's shift focus to that second key product that Marvell competes with: custom ASICs, or application-specific integrated circuits. Those are the XPUs, as known by Marvell, the custom accelerated computing processors that compete with NVIDIA. These are the engines of the data center that process the data either for training or for inference.
And this particular product has, of course, gotten a lot of attention. Broadcom, the bigger player in this XPU, a specific type of custom accelerator. Marvell is the second player in that market. And much like Broadcom, and actually also much like NVIDIA these days as well, NVLink, Fusion, Computex, Marvell's XPUs can utilize and pair well with all of their networking components. So they have the custom accelerator that they co-develop with a hyperscaler, let's say a Microsoft or an Amazon AWS. Then they provide all of the interconnects so that all of those GPUs, the engines of the data center, can coordinate with each other and make sure that they're all working towards the same goal in the most efficient manner possible. So for Marvell, they're already working on the next gen product, XPU, using 2 nanometer manufacturing technology from, of course, TSMC. Lots of manufacturing innovation in there. So this is one of the reasons why this accelerated computing market for perhaps Marvell, definitely Broadcom, and most definitely NVIDIA is set to re-accelerate the second half of this year and possibly even into 2026 as well.
So we're talking about these two products that Marvell excels in, interconnects and custom ASICs. How does that stack up against all of the competition?
Can we maybe just punt on this for a little bit? We're going to get to a slide a little bit later that shows Marvell's revenue stacked up against the top competitors. This is a crowded field, and some of these companies, they're mentioned as competitors, but maybe it's just a small segment that competes. But back to what happened to Marvell 5 to 7 years ago when they started making all of these acquisitions. In a nutshell, the pivot that they've made to get themselves into this position, 70% plus of their revenue coming from data centers and AI infrastructure, ended up being very costly to the capital structure in hindsight.
In addition to piecing together all of that intellectual property to be able to compete, Marvell then had to deal with the pandemic, digital economy boom bust, then the Fed interest rate hike cycle of 22 to 2023, and then finally the general overall chip market decline that started in 2023. Everything was down besides accelerated computing.
Yeah, and the only winner early on was NVIDIA. So everyone's showing up to the party here a couple of years later.
And you can see this illustrated in this chart by our friends at FinChat. We have Marvell's revenue, gross profit margin, and free cash flow broken down in this chart. And you can really see the roller coaster that was reflected in the revenue and especially in the gross profit margin.
Make sure you check out that link to finchat.io to nab that 15% off that we mentioned earlier in the video. So the acquisition streak was expensive. There was an ample amount of cash, though, that was paid for it. Not bad, but there was also ample amounts of debt that was also taken out to pay for some of these, especially that big one, Inphi, the approximately $10 billion purchase in 2021 for the optical components design, optical chips design. There's also been some new stock that was issued along the way to help pay the bills. Lots of new employees needed to be paid. And of course, whenever you're talking about a business like this, when you have a bunch of engineers, many of them are going to want equity in the business. So that means stock-based compensation. And those acquisitions, as they were gradually integrated and they were synergized, there were cost cuts that were taken, but ultimately because of the roller coaster that has been the first half of the 2020s, Marvell's capital structure got a bit out of whack.
And you can see that reflected as well in the balance sheet because it's really been inverted from what a healthy, high-growth company should look like. Lots of interest expenses. The most recent announced sale of the automotive networking business to Infineon for a couple $2 billion should help straighten some things out, as well as further narrow Marvell's focus on just data centers.
Okay, a couple more wrinkles though here. In the midst of the data center business, Marvell also had to initiate 2 reorganization plans, so more synergizing, that racked up some severance expenses for employees and also some non-cash impairment charges. What that means in simple terms, impairment charges, they overpaid for some of those acquired assets, especially in 2020 and 2021 when the market was in that boom time and valuations had gotten stretched beyond what was reasonable for the time.
There were also some product disputes, which were probably with a big data center customer, maybe Microsoft or Amazon, that led to Marvell settling some contract disputes. And one of these charges was related to the synergy plan that the company wasn't able to deliver on a prior agreed upon design obligation. It seems that these items are now complete, and as far as the 2025 annual report indicates, neither should be a recurring issue in the current fiscal year 2026. All of the issues that we've just talked about were some of the issues brought up in earlier videos about why we were selling our position in Marvell stock and reallocating some of that over to Broadcom. But now, what happens next? Because that's the most important part, right? What is going to happen in the future? Fiscal year 2026 will end in January 2026. So let's talk about some of the expectations that we have for Marvell.
And as we talk about this, remember, no change here from past analysis. In this market, NVIDIA eats first, followed by Broadcom, then maybe AMD after that, and Marvell to clean up the biggest crumbs. That said, let's take a look at the Q1 fiscal 2026 numbers. Here's another FinChat chart showing the quarterly revenue breakdown for Marvell. What we've done is we've put the data center segment revenue in its own standalone bar in gray. You can see 1.44 billion in Q1 of fiscal 2026. That's the period that just ended, corresponding mostly to the first quarter of the calendar year 2025. Once again, exceptional growth from this segment, up 76%, almost 77% year over year, but pretty sluggish results in everything else, still dragging down and maybe slowing down the Marvell train. But now that data center segment is over 70%, things should theoretically, hopefully, start to flip in Marvell's favor. Because it's possible that with the rollout of the new Blackwell systems the second half of this year, that whole AI infrastructure ecosystem and everything related to it follows suit. So Marvell looking like it's in pretty good position, even though the overall growth, so that's data center plus everything else, actually slowed to just 57% growth year over year, down from 63% year over year growth in Q4. Okay, but Kasey, you mentioned it's the outlook that matters more than what has already happened. So let's pivot to that. Let's talk about the outlook for Q2 and for the fiscal year.
Outlook for revenue in Q2 fiscal year 2026 expected to be around $2 billion, roughly 5% up sequentially and about 57% year over year. All of that driven primarily by data center revenue.
Not bad. 57% year over year does factor for a bit of an overall slowdown. Overall growth was 63% in Q1, but good takeaway from this, as you can see from the slide here, they are expecting an increase again in their profit margins after what's been a pretty rough stretch the last couple of years as they were scaling up the data center business, and also all the other segments were in this period of decline. Now, that said, a lot of investors are probably wondering, it appeared the Q1 update and the outlook for Q2 were very good. Why hasn't the stock rebounded more dramatically since then? Initially, after the Q1 update, the stock price declined, but things have actually since recovered a little bit. But part of the initial angst was the free cash flow per share in Q1 was 24 cents, down just about 3 cents year over year. You can blame higher R&D and CapEx expenses compared to the prior year. Marvell's still lapping some of the restructuring charges that we outlined earlier. But let's look at the free cash flow per share growth over the last few years, because this actually has been a bit of a bright spot for Marvell up to this point. And with the data center business ramping up and everything else stabilizing, this metric here could actually be about to take off here in the current fiscal year.
Yeah, and really this whole time, Marvell shareholders have continued to enjoy a modest rising free cash flow on a per share basis. And so you pair that with the stock price collapsing, the valuation for Marvell has finally been reset after all of this hype. So in blue, we have trailing price to free cash flow sitting around 42, 43x. And then on a forward-looking basis, between 24 and 25x. So significantly down from those peaks that you see just within the last year.
Let's also take a look at this based on GAAP Earnings per share, positive item here. The last 2 quarters, Marvell did finally return to GAAP net income. So on a GAAP basis, if that's your preferred metric, that's fantastic news. And so that, of course, will start to benefit the PE ratio, price to earnings ratio. Q3 of fiscal year 2025 last fall, reported last November, negative 78 cents per share, but that was because of the write-downs as well as the restructuring costs. So on a forward-looking basis, things much more reasonable, have also been rationalized about 23x as of this recording. Do note, though, these forward estimates for price to earnings are probably most Wall Street analysts using adjusted earnings per share, but I think you get the idea. If you use free cash flow and GAAP net income together, I think you get a pretty healthy picture here of a business valuation that is much, much more in line with current expectations and really provides a possible reset on the whole business valuation, perhaps an easy bar for Marvell to clear if you're looking at stock price appreciation once again in this year and next as they start to get some financial benefit from that big data center pivot.
It has been a pretty crazy few years for Marvell, but we definitely see some potential upside for the company following their Q1 fiscal year 2026 report. But is Marvell a better buy than NVIDIA or Broadcom? That's up for debate. We personally are still going to continue to hold our positions steady as they are right now.
But for you, that doesn't have to be the case. We're different than you are. Our portfolio and needs that we have from it are different from yours. So maybe Marvell is a good addition for you right now. And of course, do your own due diligence, double check our work, run this thing through your own investing framework, but that's what we're looking at right now. And we'll see you over on Semi Insider for more discussion on this topic.